You are welcome to my YouTube channel, TechBite Insight channel. Kindly subscribe. So in today's session, we will be discussing nature, scope, and functions of accounting. Hey there. So, ever wonder how businesses keep track of all their money-related stuff? Well, that's where accounting comes into play. Accounting is like the financial storyteller of a business. It's not just about numbers, it's about understanding the language of business. The nature of accounting revolves around recording, classifying, summarizing, and interpreting financial information. It's the process of taking all those transactions and turning them into meaningful insights. Imagine it as the backstage crew making sure the show runs smoothly. In this case, the show is the business. Now, let's talk about the scope of accounting. It's not just about balancing the books and crunching numbers. Accounting is like a detective, it digs deep into financial data to tell the story of a business. From tracking daily transactions to preparing financial statements, it covers a vast landscape. There are different branches of accounting too. Financial accounting focuses on external reporting, making sure investors and regulators get a clear picture. Managerial accounting, on the other hand, is more like an insider, helping the management make smart decisions based on financial data. Think of it as providing the script to the directors of the business. Alright, so what's the function of accounting? It's not just about paperwork, it's about providing information for decision making. Accounting helps answer crucial questions like, how much money do we have? Where is it coming from? Where is it going? These answers guide the ship, or in this case, the business, through the stormy seas of the market. Think of accounting as the navigator of a ship. It keeps an eye on the financial compass, making sure the business sails in the right direction. Without it, the ship might drift aimlessly. So, whether it's budgeting, financial analysis, or auditing, every function of accounting is like a toolkit helping the business navigate through the waves of economic challenges. So now let's begin by explain what accounting is about. Accounting is the process of recording, analyzing, summarizing and reporting financial transactions to meet users' needs. To break the key words of the definition down, it includes recording, analyzing, summarizing, reporting, meeting users' needs. Recording. This is the initial step where financial transactions are documented systematically. Transactions can include sales, purchases, expenses, and other financial activities. The goal is to create a comprehensive and accurate record of all business transactions. Analyzing. After recording, the next step involves analyzing the data. Analysis helps in understanding the financial health of the business and identifying patterns or trends. It involves comparing different financial elements, ratios, and trends to make informed decisions. Summarizing. Summarizing involves condensing the vast amount of recorded and analyzed data into meaningful and concise reports. Financial statements like the income statement, balance sheet, and cash flow statement are common outputs of the summarization process. Summarized information provides a snapshot of the company's performance over a specific period. Reporting. Reporting is the communication of the summarized financial information to various stakeholders. Stakeholders include internal users, management, and external users, investors, creditors, government agencies. Financial reports enable stakeholders to assess the financial position and performance of the business. Meeting users' needs. The ultimate purpose of accounting is to provide information that meets the needs of different users. For internal users like management, accounting helps in decision-making and strategic planning. External users, such as investors and creditors, rely on financial reports to assess the company's financial health and make investment or lending decisions. In essence, accounting serves as the language of business, facilitating communication about the financial aspects of an organization. It plays a crucial role in ensuring transparency, accountability, and informed decision-making for all stakeholders involved in or affected by a business. After knowing what accounting is, let's now try to differentiate it from bookkeeping. The basis for the comparison will be based on the scope, legal requirement, recording and analysis, nature of tasks and time frame. So regarding to scope, bookkeeping primarily concerned with the systematic recording of financial transactions. And also, bookkeeping focuses on the day-to-day financial activities of a business, such as recording receipts, payments, and other financial transactions. Accounting on the other hand encompasses a broader scope, including not only recording transactions but also analyzing, summarizing, and interpreting financial information. Accounting also involves a more comprehensive understanding of financial data to support decision-making and strategic planning. For legal requirement, bookkeeping often has no legal requirement whereas accounting has legal requirement. For recording and analysis basis, bookkeeping primarily focuses on the recording of financial transactions in an organized and systematic manner. Bookkeepers ensure that financial data is accurately and promptly entered into the accounting system. Accounting on the other side goes beyond recording transactions and involves analyzing and interpreting the financial information. Accountants use the recorded data to create financial statements, conduct financial analysis, and provide insights into the financial health of the business. For the nature of tasks, bookkeeping involves routine and repetitive tasks such as data entry, maintaining ledgers, reconciling accounts, and generating basic financial reports. Accounting on the other hand includes more complex tasks such as financial analysis, budgeting, forecasting, and strategic planning. Accountants use financial data to provide a comprehensive understanding of the business's performance. Relating to time frame, bookkeeping typically involves day-to-day or real-time activities to ensure that transactions are accurately recorded as they occur. Accounting on the other hand often performed on a periodic basis, monthly, quarterly, or annually, and involves reviewing, analyzing, and summarizing the recorded data to produce financial statements. Now, let's look at the functions or uses of accounting information. Basically, accounting information is used for three main purposes. This includes compliance purposes, planning purposes, and allocation of scarce resources. Now let's try and break it down. Uses of accounting information for compliance purposes. Regulatory compliance. Accounting information plays a crucial role in ensuring that a business adheres to various regulatory requirements and standards. This includes tax regulations, financial reporting standards, such as generally accepted accounting principles or international financial reporting standards, and industry-specific regulations. Legal requirements. Businesses are often required by law to maintain accurate financial records. Accounting information helps in demonstrating compliance with legal obligations, which is vital for avoiding penalties and legal issues. Transparency and accountability. Proper accounting provides a transparent view of a company's financial transactions, enabling stakeholders, including government agencies, to verify and ensure that the business is operating within the legal framework. Uses of accounting information for planning. Budgeting. Accounting information is crucial for creating budgets. By analyzing historical financial data, businesses can make informed estimates and projections for future income, expenses, and overall financial performance. Strategic planning. Management relies on accounting information to make strategic decisions. Understanding the financial health of the company helps in setting goals, identifying growth opportunities, and formulating business strategies. Risk management. Accounting data assists in assessing financial risks. Businesses can identify potential financial challenges, plan for contingencies, and implement risk mitigation strategies based on the insights derived from financial analysis. Uses of accounting information for allocation of scarce resources. Resource optimization. Accounting information aids in evaluating the performance of different business units, projects, or product lines. This evaluation informs decision makers on where to allocate resources for maximum efficiency and profitability. Cost control. accounting information helps identify and analyze costs associated with various business activities. This information is crucial for managing costs effectively, optimizing resource allocation, and improving overall operational efficiency. Capital budgeting: when businesses need to make significant investments in new assets or projects, accounting information is used in capital budgeting. This involves analyzing the financial feasibility and expected returns of these investments, guiding decisions on resource allocation. In essence, accounting information serves as a powerful tool for businesses, providing a foundation for compliance, facilitating strategic planning, and guiding the efficient allocation of limited resources. It's like a compass that helps navigate the complex landscape of business, ensuring that decisions are well-informed, compliant, and geared towards sustainable growth. The next slide concentrates on the limitations of accounting information. The following are the limitations of accounting information. Historical nature. Imagine accounting as a time traveler. It captures events that have already occurred. The financial statements reflect past transactions, but they might not capture the current economic realities or future trends. It's like looking at a photograph of a moment that has passed. Monetary measurement. Accounting primarily deals with monetary values. Some valuable aspects of a business, like employee morale or brand reputation, can't be precisely measured in dollars. It's like trying to measure the warmth of a relationship using a thermometer designed for finances. Estimates and judgments. Accountants often make estimates and judgments when preparing financial statements. For instance, they estimate the useful life of assets or the collectibility of accounts receivable. These estimates can be subjective and may vary between accountants or over time, introducing an element of uncertainty. Not all transactions are recorded. Think of accounting as a storyteller, but not every detail makes it into the story. Some transactions, especially those of non-monetary value or small significance, may not be recorded. This can lead to an incomplete picture, akin to missing chapters in a book. Ignorance of future events. Accounting doesn't have a crystal ball. It can't predict the future. Changes in market conditions, technological advancements, or unexpected events like a pandemic may significantly impact a business, but accounting can't foresee these developments. Ignores non-financial factors. Accounting focuses on the financial aspects of a business. It doesn't account for factors like employee satisfaction, environmental impact, or ethical considerations. These non-financial elements are increasingly important in assessing a company's overall performance and sustainability. Dependence on historical cost. Accounting often values assets based on historical costs. This can lead to distortions, especially when the market value of an asset differs significantly from its historical cost. It's like valuing a vintage car based on its original purchase price without considering its current market demand. Not always comparable. Comparing financial statements of different companies can be like comparing apples to oranges. Variations in accounting policies, practices, and standards can make it challenging to draw meaningful comparisons. It's like trying to judge two artists who use different canvases and paintbrushes. Overemphasis on quantifiable information. Accounting tends to prioritize information that can be quantified and measured. Qualitative aspects, such as the expertise of employees or the effectiveness of management, may not receive adequate attention. It's like judging a painting solely by the number of colors used, ignoring the artistry involved. In essence, while accounting is a valuable tool, it's important to recognize its limitations. It's like a map that guides you through known terrain but may not reveal uncharted territories or predict the weather ahead. Decision makers should use